Dubai. The name alone conjures images of gravity-defying glass towers, artificial islands shaped like palm trees, and a skyline that feels more like a 3D render than a real city. At first glance, the data suggests the party isn't just continuing, it's accelerating. In 2023 alone, the city recorded over 1.6 million real estate transactions, a surge of nearly 17% compared to the previous year. To the casual observer, Dubai is the ultimate success story of the modern age. But what most people don't realize is that beneath the polished chrome and the record-breaking sales figures, something has fundamentally changed. If you look closely at the construction sites along the fringes of the desert or the quiet boardrooms in the Dubai International Financial Center, you'll notice a series of massive, high-profile luxury projects that have quietly gone dark. We are talking about an estimated $12 billion in planned developments that were supposed to be the crown jewels of the next decade. Yet today, the cranes are stationary and the marketing campaigns have vanished. This might not be what it seems. It is easy to label this as a simple market correction or a momentary pause, but the reality is far more uncomfortable. Headlines scream about luxury penthouses selling for $80 million. A hidden shift is taking place in the way money flows through this desert oasis. There is a disconnect between the public image of infinite growth and the private reality of escalating costs and shifting geopolitical loyalties. Is this the calculated pivot of a city-state preparing for a new era, or are we witnessing the first visible cracks in a $12 billion mirage? Most people look at a stalled construction site and see a failure of engineering. What they miss is that a silent site is actually a data point reflecting a much deeper systemic transformation. To understand why $12 billion in luxury projects suddenly went quiet, we have to look past the neon lights and examine the internal conflict of a city trying to outrun its own reputation. Something doesn't add up, and once you see the pattern, you can't unsee it. This is the story of the part nobody talks about. To understand the present, we have to look at the numbers that define this silence. In 2024, Dubai's residential market saw a staggering 20% increase in sales prices. By mid-2025, transaction volumes for the second quarter alone hit 186 billion dirhams, the strongest quarterly performance on record. On paper, the machine is humming at a perfect pitch. Here is where the data begins to whisper a different story. While 300,000 residential units are planned through 2029, the actual completion rate is battling a 30% shortfall. In 2024, barely half of the expected units were actually delivered. We are seeing a massive divergence between what is announced in glossy brochures and what is actually being topped out in concrete. Take the case of the ultra-luxury segment, the homes priced above $10 million. While demand is sky-high, listings for these properties actually fell by 40% last year. Even more shocking, listings for super-prime homes above $25 million plummeted by 85%. You might think this is just because they're all sold out, but when you walk the corridors of the city's most ambitious new master-planned districts, you realize that some of these sold-out projects aren't actually moving toward completion. They have entered a state of strategic suspension. Behind the scenes, the cost of specialized labor and high-end materials has spiked by nearly 15% in the last 18 months, creating a hidden math problem for developers. If they build today at these prices, their profit margins, already squeezed by the $12 billion in capital tied up in stalled infrastructure, could evaporate. To understand why $12 billion in luxury projects suddenly went quiet, we have to look past the neon lights and examine the internal conflict of a city trying to outrun its own reputation. Something doesn't add up, and once you see the pattern, you can't unsee it. This is the story of the part nobody talks about. To understand the present, we have to look at the numbers that define this silence. In 2024, Dubai's residential market saw a staggering 20% increase in sales prices. By mid-2025, transaction volumes for the second quarter alone hit 186 billion dirhams, the strongest quarterly performance on record. On paper, the machine is humming at a perfect pitch. But here is where the data begins to whisper a different story. While 300,000 residential units are planned through 2029, the actual completion rate is battling a 30% shortfall. In 2024, barely half of the expected units were actually delivered. We are seeing a massive divergence between what is announced in glossy brochures and what is actually being topped out in concrete. Take the case of the ultra-luxury segment, the homes priced above $10 million. While demand is sky-high, listings for these properties actually fell by 40% last year. Even more shocking, listings for super-prime homes above $25 million plummeted by 85%. You might think this is just because they're all sold out. But when you walk the corridors of the city's most ambitious new master-planned districts, you realize that some of these sold-out projects aren't actually moving toward completion. They have entered a state of strategic suspension. Behind the scenes, the cost of specialized labor and high-end materials has spiked by nearly 15% in the last 18 months, creating a hidden math problem for developers. If they build today at these prices, their profit margins, already squeezed by the $12 billion in capital tied up in stalled infrastructure, could evaporate. It's a familiar situation for any global hub. A gold rush leads to a frenzy of announcements. But the subtle crack here is that Dubai is no longer just competing with its own past. It is competing with a global economy that is becoming increasingly volatile. Privately, developers are admitting that the "build it and they will come" model has hit a structural wall. In the early 2000s, the Palm Jebel Ali was the symbol of the future, until the 2008 crash turned it into a white elephant for over a decade. Now, in 2026, the cranes are finally moving back onto that island, but the $12 billion in other projects that have gone quiet represent the new ghosts of the system. This isn't just about a lack of money, it's about a behavioral shift in how the world's wealthiest people are viewing risk. They are moving away from speculative, off-plan dreams and toward ready assets. This creates a dangerous paradox. The very projects meant to fuel the next decade of growth are the ones being abandoned because they aren't finished yet. The data doesn't lie, but it does hide the truth in plain sight. In 2025, off-plan sales accounted for nearly 70% of all transactions. That means billions of dollars are flowing into buildings that only exist on a hard drive. If even a fraction of those projects continue to go quiet, the ripple effect won't just be felt in Dubai. It will be felt in every financial capital that has bet on the desert's ability to keep building the impossible. Not everyone sees it this way, of course. Some analysts argue this quieting is a sign of a maturing market, a necessary cooling to prevent a 2008-style bubble. But for the investor who just watched a 3-year timeline turn into a 5-year silence, the distinction between maturing and stalling is starting to feel very thin. Something in the gears is grinding, and the sound of that silence is getting louder every day. To see the first crack in the $12 billion wall, you have to look at the delivery gap. Imagine a city where everyone is buying, but the builders are suddenly moving in slow motion. In 2025, Dubai was projected to hand over more than 37,000 residential units. By the end of the year, the real number was barely 22,000. That is a 40% failure rate on promises made to investors 3 years ago. As we move through 2026, the gap is widening. The forecast called for 71,000 units this year, but current construction data suggests that less than half, around 34,000, will actually see a set of keys handed to an owner. This is where the story breaks. Most people assume a delay is just a logistical hiccup, but in a market where 70% of sales are off-plan, a delay isn't just a late move-in date, it's a frozen asset. Behind closed doors, contractors are grappling with a brutal reality. Material costs have climbed by 5% in the last year, and the specialized labor required for ultra-luxury finishes is in such high demand that some sites have been left with skeleton crews. The quietness isn't accidental. It's a defensive crouch. Take a look at the massive, empty shells in areas like Business Bay or the fringes of Dubai Creek Harbour. These aren't abandoned ruins, they are patience plays. Developers are realizing that if they finish these projects now, the cost of the high-end Italian marble and German-engineered glass, which now makes up 60% of baseline construction costs, will eat their entire profit margin. So they wait. They stop the cranes. They let the dust settle on $12 billion worth of concrete. This creates a familiar situation. A buyer pays $10 million for a beachfront sanctuary based on a 2023 brochure, only to find that in 2026, the sanctuary is still a pile of rebar. The subtle crack becomes a gaping hole when you realize that while these projects are quiet, the developers are still launching new ones. It's a behavioral shift that most people miss. They are using the cash flow from new projects to service the debt of the old, quiet projects. This is the part nobody talks about because it suggests a circularity that looks dangerously like a house of cards. Key data shows that bank credit to the real estate sector hit 273 billion dirhams by late 2025. The stakes are no longer just about luxury apartments. They are about the systemic liquidity of the entire region. Analysts are asking, how long can you sell the future to pay for the past? The uncomfortable implication is that the quiet project might stay quiet for a lot longer than the marketing teams are willing to admit. Not everyone sees it this way. Some argue that by slowing down, Dubai is actually preventing a massive oversupply that would crash prices in 2027. But for the person standing in a silent deal room, looking at a contract for a project that hasn't moved in 6 months, it doesn't feel like market maturity. It feels like a trap. The escalation begins when you realize this isn't just a local delay, it is a collision with a global shockwave. In the last 12 months, the geopolitical map surrounding the Emirates has shifted, and with it, the safe haven capital that fueled the initial 2023 surge has started to hesitate. By mid-2026, the influx of foreign wealth, which saw a 45% increase in high net worth residents over the previous 3 years, has hit a plateau. This is the external shock. The exit liquidity is drying up. For a $12 billion portfolio of quiet projects to become loud again, you need a constant stream of new, aggressive capital. But as interest rates in the West remain stubbornly high, and competing giga projects in neighboring Saudi Arabia begin to cannibalize the regional supply chain, Dubai's luxury sector is facing an urgent ultimatum. The stakes have been raised from a simple construction delay to a battle for regional dominance. Inside the silent deal rooms of the Burj Daman, the tone has shifted from celebratory to urgent. Developers who once laughed at the idea of over-leverage are now staring at a 15% rise in debt servicing costs. The math has turned hostile. If they continue to push forward, they risk a price war with their own unfinished inventory. If they stay quiet, they risk a total collapse of investor trust. This is the moment the pressure reaches the breaking point. We are seeing a shift where the premium on Dubai real estate, once a given, is being questioned. Data indicates that for the first time in 5 years, the secondary market for uncompleted luxury units has seen a price drop of 8%. The flip is no longer guaranteed. This creates a terrifying feedback loop. As secondary prices drop, new buyers demand lower entry points, which makes the already expensive construction of those quiet projects even less viable. It is a race against time and a race against perception. Behind the scenes, the government is stepping in with new escrow regulations to protect buyers. But for many of the $12 billion ghost projects, the damage to the timeline is already terminal. We are no longer talking about a delay. We are talking about a structural emergency. The silence of those cranes isn't just a lack of activity. It is the sound of a system holding its breath, waiting to see who will blink first: the developers, the banks, or the global elite who are starting to look at their Dubai portfolios with a newfound sense of dread. The air in the city is thick with a single unspoken question: how much longer can a skyline made of promises remain standing? Zoom out from the desert floor, and you begin to see the deeper mechanics of a city that has become a victim of its own velocity. This is the decision trap. On one hand, if Dubai forces developers to finish the $12 billion in quiet projects immediately, they risk flooding the market with supply, just as the global appetite for speculative luxury is cooling, potentially triggering a price collapse that would wipe out billions in equity. On the other hand, if they allow these projects to remain silent, they risk a permanent trust deficit that could turn the 2026 plateau into a long-term decline. Most people see a construction site. The system sees a liquidity lever. 2026, the government has responded with a quality over quantity doctrine, tightening escrow compliance so that buyer funds are locked tighter than ever until specific milestones are met. But this creates a new friction. By protecting the buyer, they have made it harder for mid-sized developers to use circular financing to bridge the gap in material costs. The logic is simple. If X, the developer finishes the project but loses money. If Y, they wait for better prices but lose the investor. This is the part nobody talks about. The strategic stalling of 2026 is actually a massive citywide exercise in inventory management. Here, the completion rate for forecasted units has dropped to just 48%. This isn't a failure of the system. It is the system deliberately slowing down its heart rate to survive a marathon. You are witnessing a transition from a momentum-driven hype economy to a selective, value-driven maturity economy. The $12 billion in silence is the price of that transition. It is the sound of a market deciding which projects are too big to fail and which ones are destined to become monuments to a previous era. You might feel like you're watching a slowdown, but what you're actually seeing is the most sophisticated rebalancing act in modern real estate. The question is no longer whether the projects will be finished. It's which side of the new Dubai you will be standing on when the silence finally ends. Is this a controlled evolution, or are the gears simply too jammed to turn? Under the new 2026 regulations, the margin for error has vanished, leaving the world to wonder, are the developers being smart? Or are they just running out of road? The skyline of 2026 stands as a silent witness to a fundamental question. Is this the end of the Dubai dream, or simply the beginning of its most disciplined chapter? We have looked at the $12 billion in stalled projects, not as a failure, but as a symptom of a system that is finally being forced to choose between the illusion of infinite growth and the reality of long-term survival. The data shows a market that is cooling by design, yet the human cost, the frozen savings of off-plan investors, and the mounting pressure on the construction workforce is very real. Privately, the elites are already moving their capital into ready assets, leaving the speculative ghost towers for those who arrived too late to the party. This brings us to a final, high-tension choice that every observer must make. If you were holding a contract for a luxury unit that hasn't seen a crane move in 6 months, would you double down on the belief that Dubai always delivers, or would you cut your losses before the strategic silence becomes a permanent tomb? Is this a temporary pause in a transformation, or a slow-motion collapse of trust? The answer depends on whether you believe the city is maturing or simply running out of air. If you think the $12 billion is just the tip of the iceberg, you aren't alone. But if you think this is the ultimate buy-the-dip moment in history, the rewards could be legendary. So, which is it? Is the system cracking, or is it just shedding its skin? If you found the hidden mechanics of the Dubai luxury market unsettling, wait until you see what is happening to the global sand economy. In our next video, we investigate why the world is literally running out of construction-grade sand and how a secret sand mafia is now controlling the price of every skyscraper on Earth. You won't look at a beach or a skyline the same way